9 months into his presidency, and Joe Biden's legislative agenda is in doubt. The U.S. is racing to avoid a potentially catastrophic default, while House Speaker Nancy Pelosi has set a new deadline of October 31st for a vote on infrastructure and a social spending bill. Joining me to discuss what this all means for investors is Andrew Busch, former Chief Market Intelligence Officer at the CFTC, and Ed Mills, Chief Policy Analyst at Raymond James. Thank you, gentlemen, both for being with us today. Andrew, I'm going to start with you. How confident are you that we get an 11th hour agreement and avoid the first ever default in our nation's history?
Yeah, it's going to be ugly for a while. You saw the comments by Senator McConnell in his discussions with Joe Biden. I think it's going to be kind of close. I think it's got the biggest risk for the financial markets, but I think it's got the smallest probability. I do think they'll find a way forward, but Senator McConnell is going to make it really difficult on the Democrats to move forward on a debt ceiling hike because they have moved forward without any Republican support over the last 6 months. And I don't think that's going to change soon.
You know, we saw Treasury Secretary Yellen say, you know what, maybe we just do away with the debt ceiling altogether, Ed. What do you think about that? And if this were to happen, even though there is a small probability, it would squash confidence in the U.S. dollar. But what would it do to the U.S. stock market?
You know, I don't think it's going to happen because that needs 60 votes in the Senate to kind of overcome the filibuster. And so I think a lot of what this is about is it's not about the debt limit. That's going to get done. This is really a larger kind of conversation about the filibuster itself and other Democratic priorities. It does have the chance of increasing volatility near term, Alexis. But I think most investors that I speak to really feel like, 6 months from now, we're not going to be talking about this. So they're not trading around that. It's going to get a little bit kind of concerning as we get closer to the X date. So the vol will be there, but I don't think a long-term market impact will be there for the stock market.
You know, Yahoo Finance's Adam Shapiro interviewed former President Donald Trump late last week. It was a far-reaching interview. In it, Trump said that the country would be, quote, ravaged by rising inflation. And I want you to listen to what he had to say about the debt ceiling, and then I'll get your reaction.
We're in trouble no matter what. If you raise it, that's not a good thing because the bill is so bad to $3.5 trillion. And if you raise it, bad. And if you don't raise it, bad. It's a bad situation to be in. The bottom line is the $3.5 trillion plus $1.2 trillion plus other things that we had to do for COVID, et cetera, et cetera. You're talking about historic numbers. And I just don't know if this economy can take it.
Now, Trump seems to be conflating the debt ceiling with the spending plan. But, Andrew, what do you make of former President Trump's remarks there?
Well, shockingly, he got the inflation component right. I mean, that's the biggest problem right now for the Fed. And I will say this, if both of these bills pass, even a smaller social infrastructure spending bill of like somewhere between 2 to 2.2 trillion, along with the 1.2 trillion, you're going to get extended inflation all over the place in the U.S. economy. Supply chain side, problems aside, you're going to have a lot of demand for things like housing with all of the affordable housing plans that the second bill has. So there's a lot of inflationary impact that's going to extend beyond what's happening today, well into 2022. And the real risk for the markets right now is that the Fed speeds up their tapering, and the markets are not anticipating that at all. That would cause a decent-sized correction in the S&P.
But, Andrew, hasn't the Fed done a pretty good job of being transparent? It's hard to believe this market hasn't started pricing in the tapering yet.
No, they're pricing in the tapering. I'm saying that if they move forward faster on it. So in other words, your November meeting, they more aggressive in their tapering, and they move forward their dot plots for when they're going to raise rates. That's the risk for the market right now, especially if Democrats pass both of these bills. That's the risk.
Ed, let's talk about both of those bills, infrastructure, social spending. We saw that President Biden's approval rating sank to, I think, just below 50% last month. How important is getting those two pieces of legislation through? How important is that to the midterm elections next year?
Alexis, for Democrats, they think it's everything. And that's part of the reason why I've been of the belief they're going to happen. A lot of Democrats are in this mode of go big or go home. Some would say they are going to have a hard time in the midterm elections, even with getting this done. So faced with the real prospect of loss, that's a huge motivating factor. We continue to look at some of these deadlines, the expiration of the surface transportation bill that you highlighted, Alexis, the end of the child tax credit in December. Those are things that are pushing Democrats to getting this done, and they really want to change the narrative. They are fully aware of Biden's approval ratings, fully aware of how many headwinds they're going into in the midterm elections. And so they think this is absolutely crucial, similar to back in 2017, when Republicans felt it was absolutely crucial to get the tax cut done. Those same political dynamics are what pushes these things over the top. If it saves them politically, that's a different story.
Andrew, what happens to the social spending plan? It started out at being about $3.5 trillion. We know it's got to get whittled down to get both sides on board. Is there a chance that it just goes away? Because when you think about it, wouldn't that be the best outcome for the markets? Because then at least it means you're not going to raise taxes.
Yeah, and I think that's a great point. And there's all sorts of problems with the package because you do have to raise taxes, capital gains, upper income earners. But I just want to warn everybody, if there's a compromise to get it to $2 trillion, my guess is that it's really not $2 trillion. In other words, there's social spending programs in there that are going to be very popular, family leave, child tax credit, that are never going to go away, because why would a politician vote against them once they're in place? So the cost of that package is going to be much higher, probably double whatever they have. So just to warn everybody, that's really misleading when you get them to start playing budgetary games of having it start in year 2 and in year 5, that kind of stuff. That's nonsense. But yes, I think for the markets, that's what they're worried about right now, is that extension of spending that the economy really just doesn't need right now to keep going. So I think that's what they're keenly worried about. And I think moderate Democrats should be very worried about the way this negotiation is going between the progressives and themselves, because the progressives are really quite zealot-like in the way that they're going. They don't care, per se, if you get the $1.2 trillion infrastructure deal done. They're willing to kind of burn down the house to get what they want. And that's where moderates who are in Republican districts, will likely lose in the 2022 midterm election. So that's something really to keep an eye on.
Alexis,
Ed, I'm going to give you the last word. Biden and Dems want to be able to point to a robust economy, but they're going to have to deal with high inflation, possibly higher interest rates from the Fed. Is that a recipe for political peril for the Biden administration in 2022?
It's potentially, but I would just fundamentally disagree with some of what was just said in terms of the way in which investors have been talking to me about this. Investors really want to see some level of fiscal spending continue. And I think the greater risk to the market is not getting something done, because that fiscal cliff really does come on at the end of the year. In the tax changes that could be in here, there are changes, but they're not as severe as originally anticipated. So those are politically perilous things if you have inflation, but Democrats really do want to give voters tangible things like the child tax credit, like paid family leave, as a way of running in this midterm election. That's going to be their strategy.
All right, Ed Mills, Andy Busch, thanks, guys. We appreciate you being with us today.